Hi, hello, how are you all? Hope you all are doing really great. I'm here with the next video in the super revision series for accounts. This is chapter 2, Reconstitution of a Partnership Firm, Admission of a Partner. The subsequent chapters cover your death and retirement of a partner. Before jumping into the lecture, the rules remain the same. This is a revision and not a full syllabus, so you're expected to have completed the chapter at least once before this. Then the second thing is you have your pen and your notebook with you to scribble along with me. And the third one is you're sitting and watching this class and you're not sleeping on your bed and listening to this class as your bedtime story, because this is not at all a bedtime story. This is for your revision and for your benefit. Make the maximum out of it, right? Let's jump into the chapter very quickly. Here, we'll start with the concept of reconstitution. Reconstitution for partnership means any change in the existing partnership agreement which results in changed relationship among the partners while the firm continues the business. So if we have to write in our mind map, okay, I just forgot. This chapter is divided into 6 parts. So the first one is the concept of reconstitution, which the main key points of reconstitution are: first is change in existing partnership. So there should be a change in existing partnership. Okay. The second one is the relationship among the, so if we write it down, we can write it down as relationship among the partners is changed. Is changed. And the last one is the firm should continue the business. Okay. These are the 3 important points. And if we go with the example of reconstitution, then admission of partner, change in profit sharing ratio, retirement of or death of a partner, all these things amount to reconstitution of a partnership firm, right? Next, now moving on to the second part of it, which is modes of reconstitution. So what are the modes of reconstitution? First one is admission of a partner. So okay, this whole chapter revolves around admission of a partner. We have other modes also. Let's just discuss them. In brief, we'll discuss about them in the chapters which they are concerned in, right? So first one is admission of a partner. Okay. Yes, of a new partner. Admission of a new partner. So in this, what happens? A new partner is admitted to the firm, and there is additional capital. Write down those points also. So there is additional capital is the first point. Then the second point is, why is a new partner added? So there is new managerial skills. For the managerial skills, why a partner can be added, where he can be added to get more capital, he can be added for his managerial skills that he has, and for expansion of business. So these are the reasons why a new admission of a new partner happens. So okay, now for this, the rule is all the existing partners should compulsorily agree to the admission of a new partner. Okay, now the second point is change in profit sharing ratio. So now, what does it mean by change in profit sharing ratio? We have a profit sharing ratio that will be given in our partnership deed. It will be as per the Partnership Act 1932, which means the partners are sharing the profits equally. So now partners may decide to change the profit sharing ratio if they have a partnership deed already. If they don't have a partnership deed, they are making a new partnership deed, whatever might be the reason. A few reasons because of which the profit sharing ratio might change. One is increased responsibility of one partner. Okay. So increased responsibility. If one partner is taking more responsibility compared to others, then he would want to earn more profit, right? And then the next one is additional capital contribution. So say one of the partners has got additional capital, like more capital compared to others. So he would expect more profit share. Yes. So additional contribution is another reason. These are few of the reasons why partnership profit sharing ratio might change. Uh, in this case, there is no new partner, but the arrangement changes, the agreement changes. This amounts to reconstitution. If you remember the definition of reconstitution, that means change in existing agreement. So, change in profit sharing ratio is also change in agreement. So, it's reconstitution. You got it? Then the third point, C point, is retirement. Retirement of a partner. Right. Retirement of a partner. Retirement may be due to old age. See, reasons for retirement can be anything. It may be due to old age or maybe due to ill health, bad health. He's not able to work because he's maybe change in interest. He doesn't want to continue in the partnership due to any other reasons, like he's not interested in the business anymore or something like that, right? But if one of the partner is going, there's no need to shut down the whole firm. They can continue the partnership, right? So the remaining partners shall continue the partnership firm. Right, that's it. The remaining partners will continue in a new profit sharing ratio or maybe the old ratio only. So there'll be a change in agreement and the terms. And if there's a partnership deed, they have to amend it by making like cutting off the names of the partners who have retired and all of it. And then the last reason for reconstitution, last point and modes of reconstitution is death of a partner. Unfortunately, if a partner has died, the remaining partners might choose to continue the firm. And when the remaining partners are continuing the business, this amounts to the firm reconstitution. Firm is not dissolved, but it is continuing. So, this is also called as reconstitution. Right? Now, moving on to the third part. We're done with two parts very quickly. Now moving on to the third part. Third part is admission of a new partner. So admission of a new partner, what happens when a new partner is admitted? Very easy, very simple. I'm expecting you all to know the answer for this. What happens when a new partner is admitted? Think. So people who could answer this, very good. People who could not answer this, you need more revision. So do it. Right? You can do it. You can watch this video again and again so that you remember it. Yes. Okay. When a new partner is admitted, there will be rights that a new partner will get by getting admitted into the partnership firm. So, what are the rights? Rights of a new partner. So, rights or powers, you can call anything, like one of them is appropriate. Then that is share in profits. One thing is that obviously, if a new a partner is coming, then he'll take share in your profit and then share in the assets. So share in the assets means if the firm is dissolved, then obviously the assets will be sold off, and whatever is the amount that is received by selling the assets will be divided into all the partners, including the new partner. Right? Okay. Now, next thing is if the new partner is coming and he's getting the rights to share in profits and share in assets, he has to give something, right? To acquire the above mentioned these two rights, the new partner has to get, so we have to write new partner brings in. New partner brings in two things. One is very, very obviously capital. Without capital, so why will anybody give him admission into the partnership? And the second thing is goodwill. So, what is goodwill? Hope you all know. Goodwill is the premium that is paid by the new partner for getting the admission into the partnership. Right? This premium is paid because the firm is earning super profits or it has a good image in the market. So this is a premium on and above the capital. Okay. Now, till here, it was just a theoretical part which you had to know. Now comes the main four exam areas which have to be concentrated, right? Now, let's start with the key accounting adjustments. Now, this is where your knowledge will be tested more frequently in your board exams. So in a practical way, this is a conceptual revision. We'll upload the master questions that I mentioned in the earlier introduction video. So you can refer to them as and when they are uploaded, right? When they are uploaded, I'll tag them down in the description. We'll go with the first one. Obviously, there's a new partner. Now, what will happen when there's a new partner? There'll be a new profit sharing ratio. So, first point is new profit sharing ratio. So now what you do is you just leave one or two or three pages, 2 pages maybe in between and write these explanations after that so that you can refer them there. This mind map is for the revision, for the last day revision. To refer the explanations and the examples, you have to go back, you have to turn the pages and refer those pages, right? Maybe you can just write down the page number here or something like that. You know, the tagging and all of that stuff you can do for the easier reference your own in your own way. I will not suggest any way because I don't want to put my words or put my methods into you. You have to do it yourself because not only in class 12 boards, further if you're going for CACMA or something like that, or CS or any other professional courses or BCom or anything in further life also, you should know how you are comfortable to revise in the last minutes. Okay. Now we'll take the example for new profit sharing ratio when a new partner is admitted. Okay, new profit sharing ratio. So what is happening is here I'll give you an example. We'll understand it by an example which says A and B share profits in 3:2 ratio. Okay. Now C is admitted for 1/5 share. Easy? You understood this? Yes. Now what is happening? C is admitted for 1/5 share. That means what is left for A and B? Here, if we solve this solution, the firm is considered as 1. Like the whole value of firm is 1. So whole value, you need not write such all of this in the exams. This is for your understanding. Whole firm value is equal to 1, right? Now, What is the remaining share for A and B? Will C's share in the firm is equal to 1 by 5. Remaining share for A and B is equal to 1 minus 1 by 5. That is equal to 4 by 5. So, see, this is very simple and logical. If you have to understand, say, example, you had a box with 5 chocolates. 1, 2, 3, 4, and 5. Okay. Initially, there were only two people, A and B, two friends, A and B, sharing these chocolates. They were sharing it as A will get 3 of them and B will get 2 of them. That is 3 is to 2. Now what has happened? C has come. There's the same box of chocolates. So this I am explaining this to you like your small kindergarten students, right? You are expected to know this. Still, I'm explaining it logically so that you can remember if you don't remember this working. Right. Now, what happened? There is another friend, A, B, and C. Now, what happened is this C who has come said 1/5, one portion from the 5 portions belongs to C. So, this belongs to C. Now, what A and B can share together? A and B can share only these 4 parts together, right? They have only 4 left because one part is taken by C. So it's 4 by 5. Okay. Now how will this 4 by 5 will be divided between A and B is you just have to multiply their earlier profit sharing ratio with this. How will we do that? Easy, simple. A share is equal to 4 by 5 is the remaining share into 3 divided by 5. Where did we get this 3 divided by 5? Here, if we see, this 3, this 3 is A share and 5 was the total share. Okay. Now this is equal to 4 into 3 is 12. Right? Wrong. It's right. And here 25. Okay. Now B share. B share is equal to again 4 by 5 into 2 divided by 5. Where did the 2 come from? 2 is the B's earlier profit share. 2 divided by 5 was the total profit share at that time. So the profit sharing ratio of B or A will be written as A's profit sharing ratio is 3 by 5 and B's PSR is 2 by 5. Right, I'm just multiplying this to the remaining share. How much did we get? We got 8 divided by 25. And C share we already have as 1 by 5. But as the denominator should be equal to make it into that proportion ratio thing like this ratio thing to write it to express this in this way, we have to get the denominators to be equal. So how will we get this to be equal? 5 to get 25 in the denominator, and so that nothing changes, we'll multiply 5 divided by 5. 5 divided by 5 is equal to 1. So basically we have multiplied 1 by 5 into 1. Yes. If you simplify this, if still you don't believe me, if you simplify this, you'll get 1 by 5. Yes? But you don't simplify it to express it in form of a ratio. And how do we do that now? It's 12 is to 8 is to 5. This is the new profit sharing ratio between A, B, and C. Okay? Okay. Now we'll go to the next point. That is your sacrifice ratio. Now, sacrifice ratio is equal to old share minus new share. Okay. How will we do that? If we continue the earlier example, so there will be no sacrifice ratio for the new partner. The sacrifice ratio will be only and only for the old partners. Okay. How will we do that? If we continue this, if we have to calculate sacrifice ratio for A and B, how will we calculate? It's simple. Now what we have to do for A's sacrifice ratio is equal to 3 by 5, that is old PSR, minus 12 by 25 it is. Okay. And B's profit sacrifice ratio is equal to 2 by 5 minus 8 by 25. Okay. And if you solve this, it will be 15 minus 12 divided by 25. That will be 3 by 25. And your this will come to 10 minus 8 divided by 25. That will be your 2 by 25. Right? I need not explain you how I did this, how I subtracted this. This is covered in your maths. Not 12th class maths, in your basic mathematics. So you should be in a position to do this. Right? If not, then please comment down. I'll post another video on this, explaining only how to calculate plus and minus. Of course, you don't need my video as well. You have hundreds of videos listed on YouTube to just do basic mathematical calculations. Okay, this is a very simple mathematical calculation. I'm expecting you to know this. Now, question is profit sharing ratio to we understand, because there is new partner and we have to give him profit, we have to calculate. Why do we have to calculate the sacrifice ratio? Why? Sacrifice ratio is calculated for distribution of goodwill. This is calculated for distribution of goodwill. Okay. Very good. Then the next, so these are the two accounting adjustments that you have to do when there's a new partner coming in to the firm. Moving forward, goodwill. Okay. Goodwill. What is goodwill? Goodwill is the value of reputation of the firm that enables it to earn super profits. Want me to write it down? And we'll write it down together, Chal. You want me? Nahi, I want to write, so you have to write. Okay. Goodwill is the value of reputation. What is reputation? Reputation is the good image of a firm that enables it to earn super profits. Okay. Now listen here. First thing, what are super profits? Super profits means anything that you earn more than the normal other firms that are around you. So it's like You have a good brand image. Say say let's take an example by going out. Let's take an example of Esquire Academy. So Esquire Academy is earning super profits. Why? Because they are student centric. Okay, they help students. We don't focus on just making you mug up stuff. We focus on making you revise smartly. It's not about writing one thing 100 times and then remembering it. It is revising smartly. We help all the students revise smartly. We help students succeed. So we make students smartly successful. So because of this, we have a good value in the market saying that they're student centric rather than just showing off the uh, ranks around or showing off the achievements of the students. We try to help students. This is our brand value. Because of which students and parents prefer joining us. We get in touch personally with everybody rather than just teaching online and just solving the doubts that we get online like randomly. We attend calls almost throughout the day, and then we solve each and every student's doubt, and then we have a personal parent a interface where we connect to all the parents personally. It's not like they're getting one computerized message or something. We connect to them personally. We have individual study group, like one student and their parents in the group with the teachers, something like that. So because of which parents can get a live tracking of all their child. This is the brand value that we have created, because of which many of the parents are preferring us. So we are earning more profits compared to the other coaching classes in the industry, other academies in the industry. Now, because of the brand value that we have, we are earning super profits. This is called my goodwill. Now, the next question is, can you touch my brand value? Can you just feel my brand value like that? Like I'm touching this pencil, this Apple pencil, I'm touching this. Can you touch that brand value? No. So, goodwill is nothing but your brand value, is nothing but your intangible asset. We know what is an intangible asset, right? So, it is an intangible, intangible asset. Okay. Now, what are the factors that affect goodwill? Factors affecting goodwill. So, the factors that affect the goodwill are nature of business, then location, obviously. Location. Now, Esquire Academy is available throughout the country. Why? We're online. Say, if I'm only having one physical class in Hyderabad, do you think everybody could have an access to the academy and I could have developed this brand value? No, because my location is online. I'm able to serve more people, right? Then there is management efficiency, and then market condition, market situation, market conditions, or market situations, or market conditions, and then moving ahead. Another one is special advantage, such as patents, licenses, and monopoly. Okay, these are the reasons why your goodwill will get affected. Now, these are the factors that affect the goodwill. Now, why do we need to actually value the goodwill? Is there any need? Yes, there is. And why? What is the need to val needs to do valuation of goodwill. Tell me what would be the reasons. So, very, very easily, one answer should have come to your mind. That is, obviously, we're reading it in this chapter. We are reading it in this chapter because it is important. It is needed to value. Goodwill is needed to be valued for admission of a partner or in the reconstitution of a firm. So, if we write those reasons only, what we have already read, so we can say admission of a partner. Okay, then what happens? Remember, we've written it here. These points, these same points: admission of a partner, change in profit sharing ratio, retirement of a partner, death of a partner. Right? Easy. We'll write change in profit sharing ratio. Okay. Then what else? Change in profit sharing ratio. Then we could just combine this death or retirement of a partner. Simple. इसके बाद after this you have to remember only 2 points, that are dissolution of a partnership firm or dissolution of a company, and then amalgamation. Dissolution is closing down, close, shut your business and go home. Amalgamation is merger of two companies. Okay, two companies or two partnership firms or two businesses. Dissolution is shut down everything, close it and go home, and amalgamation is merger. Coming together, two businesses, my dears, nothing else. Two businesses coming together. Okay. Now, what is the next one? Here, there's another, like in under the goodwill part, we have to see how is valuation of goodwill done. Okay. So, valuation of goodwill. Valuation of goodwill. So, to value goodwill, there are how many methods? You have already done this, so I expect and I hope you all know this answer. It is 3 types. Valuation of goodwill can be done in 3 ways. One is average profit method. Then it is super profit method. And the last one is, come on, capitalization method. Okay. Chalo. Let's discuss one by one. We'll first start with average profit method. So average profit method mein it is very easy. The formula will be average profit. So goodwill is equal to average profit into number of years purchase. Okay, what is it? What is it? What is it? Everything, don't worry, everything will be given in your question. If I had to give you an example for this, example is very easy. Average profit is equal to 20,000. Years purchase is equal to, say, 3. So your goodwill will be is equal to 20,000 into 3, that is equal to rupees 60,000. Don't forget the symbols. Okay. Next one. Super profit method. What does it mean by super profit? Super profit is the amount of average profit that you earn on and above the normal profits. Hey, what is normal? What is going on? Is this what is coming into your mind? Don't worry, we'll solve this. First one. First, though, we have to know what is a super profit. See here, it was easy. Average profit method. We know what is average profit and how we calculated it. Now here, this is super profit. Super profit, first we have to know what is super profit. So super profit is equal to average profit minus normal profit. Okay, clear? Everything will be given in the question. Don't worry. Goodwill is equal to, what are we calculating? We are calculating goodwill. Now we don't have to calculate super profit under this method. We have to calculate goodwill. So goodwill is equal to super profit into year's purchase. Same thing again for the example. I can give you a better example. Chalo, let's write down the example as well. In the example, I have given you capital is equal to 5 lakhs. Okay, rupees 5 lakhs. Normal return is equal to 10%. Okay. Now, normal profit, average profit is given here. The question gives you average profit. Average profit is equal to 60,000. It's rupees 60,000. So now you have to find out the super profits and the goodwill. So the solution, I would say, first we have to calculate super profit. Super profit के लिए what are the two things we need? Super profit is equal to average profit minus normal profit. We have the average profit. We don't have the normal profit. Normal profit, how will it come? Normal profit will come by multiplying normal return into the capital. So, average profit is 60,000 minus 5 lakhs into how much? 10%. That is 60,000 minus 50,000, which gives me 10,000. Rupees 10,000 is my super profit. And while calculating the goodwill, did I miss out something? Oh, I'm sorry. I just forgot to give another point here. Year's purchase. Year's purchase. Year's purchase is 3. Okay. Here, goodwill. Now, if I have to calculate goodwill, goodwill is equal to super profit into year's purchase. That is equal to how much? 10,000 is a super profit and year's purchase given is 3. That is equal to rupees 30,000. Okay. Did we understand this? Yes. The last one. Capitalization method. Capitalization method is quite simple. Capitalization method has again two types. One is capitalization of average profits and capitalization of super profits. So in like here it will be further divided into two. Okay. Capitalization of average profits and here capitalization of super profit. Okay. So for capitalization of average profit, it is easy. The here goodwill is equal to capital capitalized value minus net assets. And in this method, capitalization of super profits method, it's very easy. This is also very easy. Actually, it's the goodwill calculation is not pretty much complicated. So here goodwill is equal to super profits into 100 divided by normal rate. Okay, done. Now what did we learn here? We've learned about valuation of goodwill. You have to do it sometimes. Now the next part is treatment, counting treatment for goodwill. So actually in this whole chapter, your goodwill is another chapter in itself. Oh, what are you talking, ma'am? So obviously goodwill is the main key place where you will go wrong. So please concentrate on all the adjustments of the goodwill and this topic. You can just rewind it and view it once again on the whole thing. Okay. Chalo, now it is accounting treatment of goodwill. Here you will have entries and all, so be careful. Yeah. What, ma'am? What? Be careful. Everything is so hard. Oh, it's not. You can do it. Accounting treatment of goodwill. So now accounting treatment of goodwill will be further divided into five parts. Okay. So first one shall be, oh, let me draw five parts first. Mhm. Sorry. The first one shall be accounting treatment of goodwill when goodwill is brought in cash. Okay. Now goodwill is brought in cash. What shall we do? Just imagine you've calculated goodwill and the new partner is coming into the firm and getting that cash along with his capital. So it's very simple. He's getting capital. He is getting it in form of capital. So say he wanted to get 10,000 as capital and he ends up getting 20,000 as an additional amount of capital for goodwill. It first entry that you will pass, the journal entries. This is a revision. I cannot explain you the whole logic. That is explained in the regular class, so I cannot explain the whole logic. But please try to recollect whatever you have done. Right. So first entry that you have to pass when the partner is getting capital. Goodwill brought in cash is brought in the form of capital by the new partner. So first entry is bank account debit to new partner's capital account. Okay. And the second entry that you have to pass is premium for goodwill account debit to old partners. In which ratio? Old partners are more than one. So, in which ratio? Old partners capital account. This shall be given. We have read it. We have read it just now. The sacrificing ratio is calculated for distribution of goodwill. So, old partners capital account in a sacrificing ratio. Okay, cool. Then, now the goodwill is brought into the business and the goodwill is withdrawn by the old partners. So, this is brought into the business. And then, further, what the old partners have done, goodwill is withdrawn by old partners. So now this is a bit of technical chapter. So it is more of revising the entries and all of that stuff. And you have to concentrate on these entries and you have to remember these entries. See, these entries are quite logical. But if you don't know the logic, now at this moment, you cannot take time to understand the logics and you have to remember them. Okay. The entry that will be passed is simple. Old partners capital account debit to bank account. Obviously, they'll withdraw it from the bank. When money is getting withdrawn from the bank account is credited. Now, the third adjustment. This is okay, cool. We're cool with this. Now, the third adjustment in goodwill. So, these are the different accounting treatments in different situations. So, this third situation is when goodwill appears in the books already. Already. Oh my God. What will we do? So, goodwill, whatever is appearing in the balance sheet already, goodwill appears in your balance sheet, by the way. It's an intangible asset. So, balance sheet, it comes in the asset side. So, what is this goodwill? This goodwill is earned only and only by the old partners, not by the new partners. What did the new partner do to get this goodwill? Nothing. Because this goodwill is brought in, is earned, is made by, like, the brand value is earned by the old partners. So who should rightfully get this? The old partners, right? So here, whatever is appearing, like the whole amount that is appearing in the books, the whole amount that is appearing in the books of accounts shall be written. How will we write it? What is the entry? Old partners capital account debit to goodwill account. You are crediting the asset. That means you're writing off the asset. You're closing the asset. You're closing the account of that asset, right? With a full value. In which ratio will this go? In the sacrifice ratio? No. It will go in the old profit sharing ratio. What? You just said sacrifice ratio. Now you're saying old ratio. What is this? Cool. Calm down. Take a deep breath. Look at me straight into my eyes and see. Earlier, In the first case, what is happening? The goodwill is brought in cash. What do you think? The new partner will get the whole goodwill? No, he won't. Why will he pay the full value of goodwill? He won't pay the full value of goodwill. He'll just get his share of goodwill. Say, for example, one partner is having the goodwill of the firm is 10,000 rupees. Oh, sorry, I just said 10,000. And there's a new partner who will get 20% share of the in the firm. So he will not get the whole 10,000 with him. He'll get only 20%, which is his share of goodwill. So what he will get? He will get 2,000 rupees only. And this 2,000 shall be taken over by the old partners in the sacrificing ratio. Because see, again, understand this clearly. This is really important concept. There was goodwill and there were A and B partners who used to share 1:1 equally. So what is the share of A's share of goodwill here? 5,000. What is B's share of goodwill here? 5,000. Clear? Cool? Done? Very clear? Next, now there's a new partner C and he is getting 20% share now. What is happening now? In this goodwill that is there, C being the 20% partner of the firm, he will get this 20% of the goodwill also. Do you remember? Why? Why is this happening? He is getting share in assets as well. The new partner gets the share in assets. That means, obviously, your assets include your goodwill, and this in this 10,000 also, the new partner will have a share. His share is 20%. But why will the old partners agree? They have created this goodwill. So, what will the new partner do? He'll say, Acha, okay, I'll give you my share of goodwill. Don't fight. I'll give you my share of goodwill. Now, what is happening? You get this 10,000 into 20% is equal to 2,000 is his share of goodwill. When a new partner is coming in, he'll get only his share of goodwill. Please get it into your DNA. Old partner will get only and only his share of goodwill. I'm repeating it so many times because you will forget. You tend to forget in the exam. Okay, cool. Now this 20,000, how will the A and B share this 20,000? So in this case, you have to calculate the sacrifice ratio and distribute this 2,000 in the sacrifice ratio because this 2,000 is the sacrifice that A and B have made. Did you understand? Earlier they were getting 5,000, 5,000. Now there was 10,000. See, there was 10,000 goodwill. And A and B had whole of 10,000 for A and B. The moment C came in, the moment the C just stepped in, like opened the door and stepped in. The moment C came in, for A and B, only 8,000 is left. Huh? What? How? 8,000 is left. Wow. How? This is not fair. This is fair because C is getting 2,000 now. This 2,000 will be given to A and B. But this 2,000 is their sacrifice from the share of goodwill. So you will distribute it in the sacrifice ratio. But whereas when the goodwill already appears in the books, now see this, goodwill is appearing in the books. Goodwill is already there. And we'll not take this full headache who will get how much sacrifice ratio. Why do you want to take this headache before you know, like tomorrow your new partner is coming? Before that, share your goodwill and end the matter, na? Why do you want to keep it on the books and then you want so much accounting treatment, confusion, sacrifice ratio, new ratio, old ratio? Why do you want to do it? When you already have it in the book and you know that C is coming in your life tomorrow, from tomorrow, it's just not three of you, it's it's just not two of you, it's three of you together. I mean, in the partnership firm, man. What are you thinking, guys? Concentrate. Board exams coming in less than 1 month. Concentrate here. Okay. Three people together in the partnership firm. It's not just two of you privately in your firm. I mean, on just not two of you. So before the C is entering, just distribute whatever you have. She has not she has not entered. She has not come inside your firm. She has not come in between you people. No third wheeling has started. So before that only you share it. And before that, if you're sharing, why do you want to calculate all that? New ratio, sacrifice ratio, etc. etc. Just distribute your goodwill in the old ratio and khatam the kahanis, end the story. Yes? This much Hindi do you people know maybe, because see, till 10th we all have studied Hindi, Anyhow. Now, the next situation is when the goodwill is not brought in cash. Not brought in cash. Sure. What will we do? Think. What will we do? What will we do is very simple. Very, very simple. One entry. That is new partner. New partner's capital account debit to sacrificing, that is your old partners. See, this here it's old partners. Again, old partners capital account. Again. Here. Come on. Here. Concentration on me. Me as in on what I'm saying. Old partners capital account and new partners capital account. What will be the amount? The amount is only the share of goodwill of the new partner. And in sacrificing ratio, remember, amount is equal to only new partners, new partners share, and ratio will be sacrificing ratio. Okay. Okay. Now the last very important thing, the hidden goodwill adjustment. Oh my god, what is hidden goodwill? It is hidden, it is playing hide and seek with you? No, it is not given in the question. That's why it's called hidden goodwill. Did we understand this? It's not playing hide and seek. It is not given in the question, so you have to find it by yourself. So this situation arises when goodwill is not given. Then it will be calculated from capital contribution. Okay. We'll understand it with a quick example. So actually the video is going longer, but let's just understand it with a quick example so that we don't have any other confusions. After this, just a small bit is remaining. Okay. Now, the example is C brings in rupees 60,000 for one third share. Okay. So what will be the implied total capital of the firm? Do you know how do you calculate this? Yes, no, maybe. So C brings in one third share. One third share is 60,000. So what is the full share? So implied capital of the firm is equal to 60,000. I'll just write the calculation in red. 60,000 into 3 divided by 1. So easy trick to calculate this is whatever is the uh, fraction given here, reverse it, inverse, multiply its inverse to the capital given. So inverse is reversing it. Denominator goes to the numerator, numerator comes to the denominator. Okay, the implied capital is calculated like this. There's a whole logic behind this, but let's just remember it like this right now. If you know the logic, very good, go by the logic. If you don't know the logic, you don't have time to know the logic right now. Maybe you meet me in your CA foundation batch, their regular batch, there we can discuss this logic for the whole day. Right. But okay, now moving on. The actual capital is given as 1,50,000. Okay, this is as per books. So here the goodwill, hidden goodwill will come up. Why will hidden goodwill come up? See, what is happening? 60,000 is C's capital for one third. So based on that, for one third, if he is getting 60,000, then for the whole firm, the value of the firm is 1,80,000. And when it is 1,80,000, and the actual capital is of 1,50,000 only. So the difference between these two is because of goodwill. He's getting extra. Actually, C should have got just 50,000, but he's getting 60,000. How 50,000, ma'am? What are you talking? Why are you talking? So why am I talking is because I had to take your revision. What am I talking is, see, total capital is 1,50,000 only. What should be the one third share from 1,50,000? See, this is very simple. 1,50,000 divided by, into 1 by 3 is equal to 50,000. Okay. But how one third share as per the capital given in the books is just 50,000. But C got 60,000. Why? Because there is hidden goodwill. Hidden goodwill will be calculated on the total basis like this. We'll calculate the implied capital first and then the actual capital will be given in the question. You need not calculate the actual capital, or calculation will be simple addition. That's it. Hidden goodwill is equal to 1,80,000. That is your implied capital minus your actual capital. That is equal to rupees 30,000. Okay, in this again the C share will be one third. C's share for 1 by 3 is equal to 30,000 into 1 by 3, that is equal to 10,000 rupees. 10,000, that is what we get from this logic as well. Here successfully we have completed this goodwill part. Quickly revising what is goodwill. Chalo. One is goodwill. Goodwill is the value of reputation of the firm that enables it to earn super profits. Then what are the factors affecting goodwill? Nature of business, location of business, management efficiency, market or market situations or market conditions, special advantages like patents, licenses and monopoly that the firm has. And then what is the need to do goodwill valuation? When there is admission of a partner, you have to do. When there is change in profit sharing ratio, then you have to calculate the value of goodwill. When there is retirement of or death of a partner, when there is dissolution of the firm, or when there is amalgamation of the firm. Dissolution is shutting down the firm and going home. Amalgamation is merging of two firms. Okay, cool. Then valuation of goodwill. There are three methods to value goodwill. One is average profit method, the other one is super profit method, and the third one is capitalization method. Average profit method, goodwill is calculated as average profit into number of years purchase. And then super profit method. In super profit method, first super profit is calculated as the difference between average profit minus normal profit, and goodwill is calculated as super profit into years of purchase, years purchase that you call. And then there's capitalization method. In capitalization method, there are two things. One is capitalization of average profit, and capitalization of average profit is equal to capitalized value minus net assets. Capitalized value minus net assets is the capitalization average profit method of calculating goodwill, and capitalization of super profit method of calculation of goodwill is equal to super profits into 100 divided by normal rate. Normal rate will be in percentage. Don't forget, normal rate will be in percentage. Okay. Then next, accounting treatment for goodwill. This is the most important part, in which when the goodwill is brought in cash, the new partner will get only his share of goodwill. When the goodwill is brought into the business, the first entry that will record is bank account debit to new partner's capital account, and the next entry that will pass is premium for goodwill account debit to old partner's capital account. Okay. The next entry will be goodwill. When goodwill is withdrawn by the partners, old partner's capital account debits to bank account. This is easy. Then when goodwill appears in the books already. So this is when, before this third person is entering into the partnership, only two people are there as partners, and the goodwill is already recorded in the books even before the new partner is entering. You should divide the goodwill in the old ratio. Uh, that's it. And whenever there is only the share of new partner that is recorded as goodwill, then remember it will be divided in sacrificing ratio in between the partners. So when the goodwill is not brought in cash, all partners, new partners capital account debits to old partners capital account credit. The amount shall be the share of only new partner for the goodwill, and the ratio will be sacrificing ratio. For the first one, when the goodwill is brought in cash, also the amount will be only the amount which, with respect to the old, with respect to the new incoming partner, not the total value of goodwill. Okay. Okay. This is done, and the last adjustment is for hidden goodwill. When the goodwill is not given, it is calculated from the capital contribution. So you have to take the capital contributed in the share, and you have to find out the implied capital, and you have to subtract um, implied capital minus the actual capital. Whatever is the difference is your hidden goodwill. Coming to the last thing, last part, just a little more energy, very little energy. Don't worry, we'll be done soon. There's a very little things that are left in this, small topics. So one is revaluation. Revaluation account is used to adjust, increase. I'll write it down for you. Increase or decrease in assets, and then increase or decrease in liabilities. Okay, revaluation account is used for these two, adjust these two things. And then the rules, adjustment. I'll make a small table for this. If you remember this table, this will help you for making the revaluation account. So when there is increase in assets. So basically the entry is asset account debits to revaluation account. The revaluation account is credited. Mm, hmm. And then decrease in assets. Then revaluation, in this case, revaluation account is debited. As the opposite of increase in assets. And there is increase in liability. The increase in liability is debited. So increase in liability is debited, increase in asset is credited. And there is decrease in asset in liability. Decrease in liability is credited to the revaluation account. This is the small table that you have to remember. What else? Revaluation, then you have to make a ledger account and calculate revaluation profit or loss. And revaluation profit or loss is transferred to all partners in all ratio. Then calculate revaluation profit or loss and then transfer it to old partners in old ratio. Okay. Okay. And then there are some other things, other points that you have to remember in this other points. You can just add one more branch in your mind map or just, do it in this way. This, the first point is accumulated profits. Accumulated profits or losses. Okay. So when there are accumulated profits or losses, it's simply you divide it in between the old partners in old ratio. Okay. So it's for profits, the entry shall be reserve account debit to old partners in old ratio. Old partners capital account, old ratio. Then is when it is regarding the losses. It's just the opposite of this. That is old partners capital account debit to P&L account. Okay. So losses include accumulated losses include P&L debits or deferred expenses, and your profits include what? Your P&L credits and general reserve. Okay. So this is also an old ratio. Remember old ratio. Okay. Then what are the other points? Then there are adjustment to partners capital. What are the adjustments that you have to make to partners capital? Okay. Adjustment to partners capital. So the adjustments will be like whether you have to decide whether the cash has to be brought in, whether the cash to be brought in or withdrawn. So this is the basic sum of everything that we have covered in this chapter till now. So what are the adjustments that will happen to your capital, partner's capital? One is goodwill. It We have discussed it for so much time. Then revaluation. Then you have reserves and new profit sharing ratio. That's it. These are the adjustments after which you decide whether to bring in cash or to withdraw cash. Then I think the last topic of the day, that is AS 26. The last topic. Little more patience, very little more patience, please. AS 26 compliance. Okay. So, AS 26 compliance, this is very important from your theory perspective. So, the summary points of this is purchase goodwill can be recorded. So, when you're purchasing a thing or another firm, then the goodwill can be recorded. You can't record it on your own saying that, oh, my value is 1 crore. My brand value is 1 crore. No, you cannot do that. Right? So, the second point is that internally generated goodwill cannot be shown as asset. Then goodwill should be written off within 10 years. Okay. And then the last one, at reconstitution, goodwill is not shown in balance sheet. Okay. These are the 4 points that you have to remember. Say goodwill has to be written off even if it's appearing in the balance sheet earlier. We have to write it off. We cannot show it in the books. So here, our comprehensive revision of Chapter 2, Reconstitution of a Partnership Firm, Admission of a Partner, is completed. Soon I will upload the video of master questions. Please go through that. Other than that also, please try to solve the questions before that video comes up on YouTube. Please try to solve your questions once from the NCERT textbook so that you have a good clarity over the concept. If you have any doubts regarding the lectures that have been uploaded or any other doubts from accounts, then you can contact me at 801-909-1616. This is my number where you can text me on WhatsApp. Only texts are entertained. So please text me on WhatsApp and I'll reply to each and every query personally. Okay? Don't call on this number. Okay? This is our academy's number as well. So please drop a text of your doubt if you have a doubt in any question, please take a picture of that question and send it to us. Then we'll solve the doubt. Okay, this is the number that you have to WhatsApp on. Okay, don't call. Okay, you can text on any time, but please also consider the time that you're texting, and we'll not delay the replies, we'll give the replies in the reasonable time. Okay, so let's end this video here. Till then, prepare well, take good care of your health, have healthy food, drink lots and lots of water, and keep revising smartly. Chalo, bye bye.